got a year-end tax planning show for you today. So while your thoughts are on the holidays, we're thinking about taxes. So that may make us come off as like an Ebenezer Scrooge, if you will, but the reality is that if you listen carefully to this program, you're going to get a Christmas gift from us in the form of maybe some extra money in your pocket, right? Because if we're talking about taxes, then you know that if you pay less in taxes, that means the money stays in your pocket. So in a way, consider this show our Christmas gift to you. Joining me on the program to help with that Christmas gift is fellow certified financial fiduciary, certified financial planner, certified public accountant, Kristin Kalley. Welcome to the program.
Hi, good morning, Joel. Thank you for having me.
Well, it is good, as always, to have you. Obviously, your expertise is on the tax side, and so we want to bring you into today's program to engage in that conversation with our listening audience, and we've certainly got a lot to talk about, that is for sure. But I guess we'll make it a little bit of a holiday feel. What's on your Christmas list?
I've been kind of procrastinating that. It's unfortunate that shipping is so quick nowadays that I've just kind of been putting it off, but now I might just have to take an old school trip to the mall and do some shopping.
Or one idea that you could get for Christmas, which is available here at the office, is, of course, our new book. How's that for a shameless plug?
Mm-hmm. I think that'd be a great gift.
There you go. Next Gen Dollars and Cents, hard copy, available, as we have said, between now and the end of the year. Free for the asking. After December 31, you're going to have to go to Amazon. By the way, Amazon already sold out of this.
That's incredible.
Isn't that amazing? They aren't supposed to sell out of anything, but they already sold out. So it is currently on back order at Amazon. So if you want your copy and you need it before the holidays, hey, we'll ship it to you absolutely free of charge. So make sure you take a moment and request a copy of your Next Gen. It's pretty much, as I think, on everybody's holiday shopping list this season.
I think so.
Yeah, exactly. Speaking of this past week, though, a bit of a milestone of sort. Speaking of us not being Scrooge, the market certainly not being Scrooge as well. Dow broke through 37,000.
Also very incredible.
Very incredible indeed. What I'm hoping happens is it goes a little bit further, because for those of you who are regular listeners to the program, you know that every year at the beginning of the year we do our Fearless Forecast show. So that's coming up in a couple of weeks. And I believe, I was looking at the historical data on it, and I believe we mentioned something like 40,000 on the Dow. So we're not quite there in terms of 37,000, but we're getting closer. I guess we've never seen 37,000 on the Dow.
No, all-time high.
All-time high. So, and of course, all of that is related to the announcement out of the Fed this past week. They met, last meeting of the year this past week by the Federal Reserve, that basically they said, okay, we like what we see on the inflation data and everything else looks okay. So we are definitely shifting gears and projecting by their own statement a total of about 3 rate cuts during the course, really probably more the back half of the year. And obviously the market certainly likes cheaper interest rates, that's for sure.
Yep, it looks like it.
Certainly a big move in the market, particularly on Wednesday this past week, when that was the decision from the Federal Reserve was announced. It's almost like if you're watching the market minute by minute, when the Fed decision came out at 2:15 on Wednesday, it went almost straight up. So some interesting, I guess, little Christmas gifts that are coming across the board. So on the program, we're going to talk about sort of 3 different things, right, Kristin? So what do we got that we're going to kind of talk to people about in terms of these tax items that people need to be aware of between now and the end of the year and thinking into 2024?
Yep. So the first one is there's a huge push for Roth conversions, things that are translated into Roth. Just a big push for Roth. So we're going to go over 4 examples of that. Also, we're going to go over the inflation adjustments to your tax brackets and your standard deduction and that sort of stuff. And then also there is a red alert for taxpayers. This has to do with the 1099K, which is a third-party platform-based form. So things to keep an eye out for that.
Certainly a lot to talk about here and a lot to unpack. We'll start with that first piece, which is the difference, this conversation about Roth, and we hear a lot about it. Let's recap for our listening audience, sort of the difference. What's the difference between the Roth versus the IRA? How does that all work out?
Right. So the IRA is much like your pre-tax 401k. They're the same. They go in as a pre-tax deduction, so you get a tax deduction now. But in the future, when you eventually withdraw from the accounts, that's when you pay the taxes. Whereas Roth is the opposite. So right now, you're not getting a tax deduction, but in the future, it could come out tax-free.
Boy, and I'll tell you, that is a big conversation. And you see it not just out of Washington, but also in the advertisements that you see in the financial services industry. And the thing that always concerns us about it, and we've been concerned about it now for 25 years, is that what people forget is that the notion of the Roth, when you look back to the legislative history, when that was first created, the concept behind the Roth was that it was going to be a revenue generator for the folks in Washington, D.C., because, as Kristin's just explained, it's after-tax money that goes in. So you don't get to save money on the taxes when it's going in. You don't get to save money today. The tax savings is in the future. Well, I guess times really haven't changed a whole lot, right? Because when it was first invented or first introduced, there was a need to raise money or raise revenue in Washington. So the concept was, well, we'll give people a reason to pay taxes now if we give them the promise that sometime in the future, when basically all of us are, outside of our electability, or we've all passed away because we've been elected so many times to Congress. The reality is that the Roth is certainly a tax revenue generator, and that's a lot of what we hear throughout, of course, the across the board. And now that Roth has really become a big focus of the folks in Washington.
Oh, yeah. We see it all the time. And there's a lot of people just, advertising tax-free retirement, convert to Roth.
Correct. Except they kind of leave that last part in fine print. Everybody talks about, oh, don't you want a tax-free retirement? And it's tax-free, and that's fantastic. But there is some fine print. Eventually, you've got to pay for it. Kristin, you ran into this scenario that really, you really have to kind of think through this and engage in a real analysis before you make a decision like that.
Right. We had somebody call in who had seen a YouTube ad saying, tax-free retirement, convert your whole 401k to Roth. So that's what he did. He just did a few clicks on the computer and converted everything over to Roth in a matter of seconds.
Wow.
Little did he know, come tax time, which was a couple months later, there was tens of thousands of dollars on his tax bill from that Roth conversion. And at that point, there's really only 2 options. You get on a payment plan with the IRS and make payments for the next 6 years, or you take it out of the Roth that you just converted to pay the tax bill.
Yeah, I mean, I'll tell you, if you're getting your advice online or by watching some videos or things like that, that really just underscores just how important it is to really focus and make that individual analysis. Don't really look at these ads and say, oh, this is no problem, I'm just going to go ahead and do that, because it can really create major tax implications for you, and you certainly would not want that. That would be something like Ebenezer Scrooge would do to you. Convert, and I'm not going to tell you about the giant tax bill that's going to hit you all at one shot. So we're going to take a break. When we return, we're going to talk about some of those more detailed nuances of how the folks in Washington are really pushing the Roth. Coming up next here on Dollars and Cents. Welcome back to the program. You're listening to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. Also available on any number of podcast platforms as well. So if you have trouble finding us on your favorite podcast channel, just go to our website, nelsonfinancialplanning.com. There you'll see a bunch of icons. Click on the one that looks most familiar to you, and you'll get immediately connected to our channel. Once there, make sure you subscribe, and then that way you'll get notified when we upload new videos or new podcasts to those channels. So my name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, one of which is sitting next to me, Kristin Kalley. Welcome again to the program.
Hi, Joel. Welcome. Thank you.
Kristin is a certified financial fiduciary, a certified financial planner, and a CPA as well. So obviously that means we're talking a little bit about taxes. Before the break, we were talking about this big push that we've seen rising its head out of Washington over the course of the past 25, 30 years, this notion of encouraging people to do the Roth and as a really more of a revenue raise for the government. Now, again, we're not saying that the Roth might not be a good option for you, but far too often, Kristin, as you were sharing that story before the break, people just kind of jump to this notion of, oh, I'm going to convert or I'm going to do the Roth, and don't really think it through, don't really think about how it relates to their personal situation.
Right. Some people see it as an all or nothing approach where you need to convert everything today, where we see it's most beneficial if you kind of spread it out over a couple of years. But every situation is different, so we like to run that analysis.
Well, and that's something that is unique at Nelson Financial Planning because we actually do have a tax department. Kristin, obviously you're part of that tax department, and we actually run the tax return. Rather than just kind of writing some numbers down on a piece of paper, we're using some pretty high-end software that we use for all of our tax preparation process, and ultimately that gives us a pretty good comfort level that we're giving you a pretty accurate estimate of what that picture would look like and whether it makes sense to do any kind of conversion or whether you fund the Roth accounts along the way or whether you fund the traditional side.
Right. Both have their benefits.
Both have their benefits indeed. So let's break it down. So we got 4 different kind of ways in which the folks in Washington have really been pushing the Roth. What's the first one you've got on your list?
Yeah, so we've talked about this one on a few shows before. So it's now adding a Roth option for employer matches. So previously, if you're contributing to your 401k, you have the option to make your contributions either pre-tax or Roth. And then your employer match, which usually is about 3% or so, would have to go into the pre-tax category. That was the only option. In 2023, they opened up a Roth option for those employer matches. Many platforms have not rolled out this change yet, so you may not have seen it. We might start seeing it more in 2024. But this is a way to get some more tax revenue because those Roth contributions or Roth matches are going to be taxable in your taxable income.
Well, and the interesting thing about this, and I think we've talked a little bit about this earlier in the year when this first was kind of getting introduced, is that if you're the employer and the employee, this is a pretty unique, this one has a pretty unique feature to it when you're the employer and the employee, that's for sure.
Right, because you get the deduction for making a matching contribution on the employer side. And then you would have to report it in income, but that offsetting deduction in income essentially makes it tax-free.
Yeah, it's really a great option for employer-employee. That's why I'm not, I think we talked about all of this stuff. It keeps evolving, right? They keep changing the rules. They keep saying, okay, well, this is fine, but in this particular situation, it's going to be a little different. So we obviously, that's why we do the show every week. That's why, Kristin, you're regular on the program as well, is to talk through this and to keep people informed on what they need to know, because we've certainly seen a number of these things that we're going to talk about today have in fact changed over the course of this year as well.
Right. And, I mean, this one came out for 2023, and we still haven't really seen it as an option for a lot of people yet.
Right. So what's next on the Roth push, if you will, out of Washington.
Yep. So now simple IRAs and SEP IRA plans now have a Roth option. And this is going to be available for employee contributions as well as employer matches or employer contributions.
So that is helpful because now, and different in the past, because employer contributions, particularly on these kind of smaller plans, were not able to be Roth, but now they're going to be able to be on the Roth side as well.
Right. And for a lot of self-employed individuals, the only way that they could contribute to a Roth would have been a Roth IRA, which has limits of, it was $6,500 for 2023, it'll be $7,000 for 2024. By giving this Roth option in simple and SEP IRA plans, they have the option to contribute more to the Roth side.
Gotcha.
With the
Okay.
higher
Well,
limits.
Yeah, that's good. Obviously, with the higher limits. Now, this next one is one that's kind of been one of the ones that has changed somewhat over the years. This has to deal with that catch-up contribution that people can make.
Right. So the catch-up for high earners, which is going to be classified as if you make $145,000 or more. So starting in, it was supposed to be 2024, but it's been delayed to 2026. So if you make that catch-up contribution, it's for $7,500. You can only make it to the Roth category. You cannot make a pre-tax contribution.
I mean, a pretty good example of how the folks in Washington have said, wait a minute, we need tax revenue. And particularly if I'm a higher income earner, right, because this only applies to higher income earners, then, then they're generating more tax revenue if we require them to do the Roth, particularly for these after-tax contributions. Now, this one was met with a lot of resistance, more from the practical point of view, right?
Right. I think that's why they keep delaying it. It's just hard to get it implemented.
Right. Yeah, well, it's definitely impacts those folks that have higher income that might benefit more by doing that catch-up contribution on the pre-tax basis, which is what it's always been allowed to be done. But now to be forced into the Roth, okay, that is raising your tax bill, that is creating more revenue to the government, and that ultimately is certainly the current underlying all of these changes that we're talking about. So what else is on our list here?
Yeah, the last one, this doesn't actually bring Washington any revenue, so this is a nice one.
That's a miracle. They actually did something that didn't line their coffers. Okay, what's this one got to do?
So with the 529 plans, what you can do is roll over some existing balances to a Roth IRA for your beneficiary. So if it's for your child, you can set up a Roth IRA and transfer the funds from the 529 into the Roth IRA on their behalf. Yeah,
this certainly is an interesting one, and one that I know you and I have talked about a bunch over the course of the year. You know, the one thing about the 529s that I think is important to remember is that they're kind of an evergreen account. Right? So you don't have a particular age where you have to take the money out versus, say, a Coverdale Educational Savings Account where it's money can't be in there until after age 30. You have to make sure that the money is coming all out. Whereby at 529 you can kind of leave it and sitting in there. So I kind of go back and forth on kind of what's the best option on this one. Do you leave the money, let it sit, continue to grow? Because with 529s, you can always change the beneficiary.
Right. Yep.
You can change the beneficiary to potential future child down the road. I mean, you start to spin that out over an extended period of time. There's really some value about if there is a residual balance in a 529 account, once that child has gone to school, then maybe you do just kind of leave it alone. Certainly, this is another option to be able to kind of use that money to fund a Roth. My reaction is hopefully they're working. If they graduate from college, hopefully they're working and can get some money to fund Roths on their own. Yeah,
or you could really do both because the Roth IRA option is only limited to $35,000. So if there is residual over that, then you could leave it to a future grandchild or along those lines.
Correct. Although with the cost of education, hard to have a lot of residual balances left over on these 529s. But yes, those obviously underscores the general trend in Washington. When we get back, we're going to go through kind of the normal inflationary adjustments and what that means for you ultimately it means good things for your taxes, more money in your pocket. We'll talk about all of that when we return here on Dollars and Cents with Joel Garris and Kristin Kalley of Nelson Financial Planning. This is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Not trying to be Ebenezer Scrooge on this program, but we are talking about taxes. More importantly, talking about ways in which you might be able to reduce your taxes. And then, of course, that could be like our Christmas gift to you. If you have lower taxes, then that means you have more money in your pockets. Joining me on the program this week is Kristin Kalley, one of our fellow certified financial fiduciaries at Nelson Financial Planning. She also happens to be a CFP and a CPA. Welcome back to the program, Kristin.
Thanks, Joel.
Always a pleasure to have you. So there's normal adjustments that occur inside the tax code every year. These are kind of the inflationary adjustments. What are we seeing in terms of what those are going to be for this coming year?
Yes, yeah. So I took a look at them, and each bracket went up about 5%, between 5 and 5.5%. Really to keep up with inflation,
Sure.
Pay raises, those sorts of things.
And the benefit to you and to me and to everybody that's listening to the program is when those brackets, if those brackets expand, that means you're going to have a little bit more money that's applicable at a potentially lower rate than what you might otherwise have. So there's kind of the tax savings that comes with these normal inflationary expansions that happen inside the tax code.
Right. Because if you're at the upper end of, say, the 22% bracket, and you got a 3 or 4% pay raise, if we didn't have these inflationary adjustments, you'd be in the 24% bracket. So by having this adjustment, you stay in your same tax bracket.
And if that were to happen, then you're basically paying more taxes on what was in essence an inflationary adjustment to your income, which then defeats the whole purpose of getting an inflationary adjustment because you're having to pay more in taxes. So what were some of the big changes in terms of 5% roughly on the income tax brackets, right? What's the rest of it look like?
Yep, so we got our normal adjustments. So 401ks, 403bs, now it's $23,000, so it's up $500. Last year it was $22,500. The catch-up remains at $7,500. So the maximum you can put into these accounts in 2024 is $30,500. All right, and we got a couple more here, so I'll run through them. So the simple IRA limit also went up $500, so that's going to be $16,000 for 2024. The catch-up also remains the same, so that's going to be $3,500. SEP IRAs also went up a little bit, so up to $69,000. That's up from $66,000 in 2023. And then IRAs also increased, so they were $6,500 in 2023, and now they're $7,000 for 2024.
And the important thing for folks to remember with these higher contribution limits is that, you know, every year if you're trying to maximize out, right, then you may want to look at that payroll withholding that you're putting into that employer plan to adjust it upward a little bit to take into account these higher contribution limits. And of course the big one is when the calendar turns for you to be age 50, then that's when you can kind of do those extra catch-up contributions that you were talking about.
Right. So with the IRAs, that catch-up stays at $1,000. It was supposed to be adjusted for cost of living and inflation starting in 2024, but we just haven't seen that yet. So we'll see if that happens in 2025.
All right, well then that sounds good. So that is increasing as well. And then similarly, thinking back to kind of the standard deduction inside of a tax return as well. We talked about the income tax brackets expanding based on inflationary adjustments. Standard deductions also increased as well. Is that correct?
Yep. So standard deduction for a married couple was $27,700, and now it's $29,200. For single individuals, similar, it's $13,850, increased to $14,600.
So basically, we'll translate this into real dollars. So for a married couple, that increase in standard deduction to be about $1,500, right? So if you're in the 22% bracket, then you're going to have about a $350 tax savings solely as a result of that increase in the standard deduction.
Right, yes.
So that, good way to save some money just based upon the inflationary adjustments that happen in the tax code as well. Anything else that's shifted around? What else has shifted on an inflationary basis for this next tax year?
So looking at the gift and charity side, so the gift exclusion is going to be $18,000 for 2024.
Okay.
And then another number that has been increased for inflation and cost of living adjustments is the qualified charitable distribution number. It's been $100,000 for a couple of years now, and now it's actually going to increase to $105,000.
So both of those are pretty important. The first one, that gift exclusion, that $18,000 is the amount of money that you can give to anybody and not have to worry about tax implications for the receipt of that or for the giving of that, right? So
Right.
if I wanted to give you 18 grand, I could. If you wanted to give me 18 grand, you could. And there's no real tax or reportable consequence on that.
Right. And that's per person. So if you're a married individual, you get double that.
Correct. And oftentimes if folks are trying to gift their kids for like a house down payment or things like that, that's typically where we would see this gift exclusion number become very important.
Right.
And then the qualified charitable distribution, if you're a regular listener to the program, we like to talk about that a lot because that's a great way to give money to charity and have that be an automatic write-off on the front page of your tax return. So good stuff on the qualified charitable distribution. So that is good. So then certainly some tax savings to be had on that across the board. So something to kind of look forward to. I know a lot of people are out there trying to look forward to the next couple of weeks. Got Christmas holiday coming up and then New Year's and things like that. It looks like some of the holiday shopping numbers at least are coming in where we're still continuing to see good consumer spending. So obviously that contributed to kind of the market perception, particularly this past week with the Dow crossing that 37,000 mark, where with good consumer spending, potential for lower rates, all of those things working well, at least here at the end of the year in terms of the market. Have you gotten all your Christmas stuff, all your Christmas shopping done, or are you still trying to, you said you were getting, it become too easy knowing that the packages are supposed to arrive super quick.
Right. I'm about halfway, I would say, 50%.
All right. Well, here we'll do our shameless plug. Speaking of Christmas lists, don't forget your copy of Next Gen Dollars and Cents. All you have to do to get a copy, it should be on your Christmas list, and our listing audience Christmas list, Next Gen Dollars and Cents, the book that we wrote a couple of months ago, or didn't write it a couple of months ago. We wrote it during the course of the year. Published in October, sold out on Amazon. So in order to get a copy, you need to call the office 407-629-6477 or go to our website, Nelson Financial Planning. We will get a hard copy in the mail today. If you don't know what the book's about, it really is a good description of the essential tools and strategies that you need to know and to ultimately achieve financial success over time. So make sure you ask for your free copy of that. Speaking of things that caught our attention, you shared this article with me that you read in your Florida CPA Today magazine. And this really does get into, I think, what is going to be a major issue for taxpayers going into next year. What is this all about?
Right. So this was a red alert on Form 1099-K. So Form 1099-K reports payments you received for goods or services during the year, and it's usually going to come from a credit card platform or if you use online marketplaces or apps to collect payments. So what the nuance of this is whether or not Venmo or PayPal or those sorts of different platforms are going to issue these 1099-Ks. So what the big legislation is that they're lowering the limit or the threshold down to $600 per person. So if you receive payments of $600 or more, you'll probably be receiving a 1099-K. So that came out in 2022. The previous rules before that were the thresholds for $20,000 or 200 transactions.
So rarely would we ever see that, unless it really almost is a business. Like if you're going on Ticketmaster or selling tickets or, selling you're not going to get that. But now these thresholds really have dropped pretty dramatically.
Right. And we have some good and bad news on that. So the good news is that it is delayed once again, so it's not going to be that lower 600 threshold. But the bad news is that it is coming. So they have a time schedule for it.
Correct. And they've also changed the number. And we'll talk about what that is when we return after these messages. So stay tuned through the break for the rest of Dollars and Cents with Joel Garris and Kristin Kalley of Nelson Financial Planning. Welcome back into Dollars and Cents. Joining me today on the program, Kristin Kalley, fellow certified financial fiduciary, certified financial planner, and CPA at Nelson Financial Planning. So this 1099-K thing is not really it's not new per se, because it's been around a long time, but what is new is the reporting threshold, right?
Mm-hmm. Yep, it's decreasing from 20,000 down to 600.
So that's going to pick up a lot more people. Going to make people's taxes more complicated. And what happens when someone has a more complicated tax return?
It's going to cost them more.
It's going to cost them more. So either way, this is going to cost you no matter what. So sadly, we are ending the program with kind of that Scrooge theme, because this one is going to cost you more. But how you can reduce that cost is know that this is coming. And so if you're doing anything on any of these online platforms, so it's Venmo, it's Airbnb, it's eBay, you name it. If you're doing it, then the information and the dollars are going to get tracked. So what that means is, in order to save on taxes, you've got to have pretty good records of what you did.
Mm-hmm. You just got to be aware of it too.
Right, because it's important to track it. You got a couple of good examples that this article in Florida CPA Today, I think it was a guy by the name of Dan Henn, really outlined. So why don't you share some of those stories and how they might ultimately impact people?
Yeah. So the first scenario that Dan Henn gives is, let's say that you sell a couch on Facebook Marketplace for $700. So you got a new couch, you don't need the old one, you just want to get rid of it. You purchased the couch for well over $700 a couple years ago, but you were just trying to get rid of it, so you sold it at $700. So now you're going to receive a 1099-K from Facebook Marketplace saying that you received $700 of proceeds, income, essentially.
Because it's the one single transaction, because it's not based upon number of transactions. Mm-hmm. By virtue of a $700 sale of a sofa, you were above the $600, so now you got a tax document on it.
Right. So you bring it to your CPA, or if you're doing it yourself, you're like, what am I going to do with this? So the answer is that technically it's not supposed to be reported, because it is a personal income or personal loss that you reported or you're showing there. But because you received a tax form, you have to show it on your tax return. So don't disregard it. You do have to show this on your tax return. But essentially what you'll do is report the income at $700 and then back it out on another line to reduce that $700 down to zero.
Talk about just on the basis of selling a sofa, right? You become much more complicated. You've got to go to Schedule I and fill out information there. Then you've got to report that it was a personal item. That's a mess, and that situation is going to apply to a lot of people, so they certainly need to be aware of it. What's the next one that this article kind of outlined for listeners to be aware of?
Yep. So the next one is, let's say you received a 1099-K, but you don't know where it came from. So you go look at your Venmo account, and you paid for dinner for you and your friends, and they Venmo'd you back later for their portion, and now you receive this 1099-K for essentially reimbursements from just a night out with your friends. So the question is, what do you do with this form? So like the first scenario, you must report it. You receive the tax form. There's no way of getting around it. It has to go on your tax return. But similar to the first one, reimbursements are not taxable. It's not income to you.
Right.
So you'll have to do the same sort of thing and essentially just say this is a 1099-K received in error and back out the amount.
What's terrible about this is, as you know, as a listener to the program, you certainly heard us talk about this concept before. When it comes to your taxes, the burden of proof is on you. It's not on the IRS. So you're going to have to, I mean, I don't know what you're going to have to do to prove, hey, it was me and my buddies and they just Venmoed me back. But that burden of proof is on you as you report this. And this is why that we've seen this really shift and move. It was going to be 600, that's gotten delayed, but it is now going to be implemented at that $5,000 level, which, you know, depending upon how often you're going out and things like that, you could certainly have that get triggered as well. And again, those two are very normal scenarios of what you would just encounter kind of in everyday life. And the same thing is true on this next example. That's for sure.
Yep. So on this next example, let's say you sold some concert tickets. So you managed to get your hands on 4 Taylor Swift tickets, but you only really need 2. So let's say you paid $800 for the 4, and you were able to sell just a pair of 2 for $1,000. So this actually is a gain to you. You sold them for $1,000. You only paid $400 for those 2. That's a $600 gain that actually needs to be reported on your tax return and taxed.
And now you won't be able to, but because that's always been true, right? I mean, that's not a new tax rule where if you get tickets and you sell them at a profit, then that's a gain, and you've got to pay taxes on it just like anything else. Now though, there's a tracking mechanism for it. Right, so all those Swifties are going to have to pay taxes when they resell the tickets. They would have had to have done that in the past, but now they're not going to have a choice. They're going to get a tax document on that. That's for sure.
Right. So that's not going to make a lot of people happy when they have to pay taxes on it.
My goodness. Okay, what else is the ripple effect of this change?
So the last one is related to businesses. So let's say you use a third-party platform to collect credit card payments. So you do work for one of your clients, and they pay you in 2 different ways. So they pay you $500 through a check and $1,000 through a credit card. So the client sends you a 1099 NEC for $1,500 for the payments that they sent you. The credit card payment or the platform also sends you a $1,000 1099K for the credit card payments that came in. So now you've got a $1,000 1099K from the credit card payment platform, and you got a $1,500 1099 NEC from your client. So that's $2,500 of income that will have to be reported on your tax return, although you only collected $1,500.
So you're going to have to figure out a way to kind of back that out as some type of a return or a misreporting or something like that when it comes time to do your taxes, because now the burden of generating these tax documents is sort of across the board. So what the natural reaction is going to be is you're going to see more and more providers generating out these tax documents because nobody wants to get in trouble with the IRS as it relates to reporting what was going on your particular platform.
Right. So if you have the option to designate your account as personal or business, make sure you go in and kind of take a look at that. And if you do use it for business, maybe set up 2 different accounts, one for personal, one for business, just so you can keep track of this a little bit better.
That's a good suggestion because ultimately it's going to be on you to prove what's what. I mean, as the taxpayer, the burden of proof is always on you to make sure that you're reporting things on an accurate basis.
Yeah, and it sounds like a lot of headaches. If you say your income is this amount, but your 1099s are more, it's just going to be a headache for the clients, for the CPAs, for everybody.
Yeah, talk about a compliance nightmare and a tax preparation nightmare as well. That, you know, those that are trying to save money and maybe do taxes on their own, the amount of mistakes and confusion that this is going to create is just astounding, which is why I think they still haven't come to a final. But I guess the final answer for next year is that the $5,000 threshold is going to kick in. So they're not going to go all the way to the 600 threshold, but that is still on the books. It is part of the tax code. And what's interesting about this is that Congress mandated the $600 number. It's the IRS that is choosing to not enforce what is on the books legislatively. And again, thankfully that they're not, because this would be a mess. But it's on the books at 600. At some point, the IRS is going to have to start to enforce that, because otherwise, what's the point in Congress making laws?
Right, right. So at least, it's not the full 600 this year. So we have the $5,000 threshold going into 2024, but 2025 is set to be 600.
Okay,
We'll
so
see.
make sure if you're doing any of these, basically having any normal activity in life, that you keep good records of it, because the IRS is going to want to know, and there's a lot of different reporting requirements that are going to be kicking in. So make sure you keep track of all of that information, because after all, the burden is on you. Well, we're going to wrap it on up and get on out of here. Enjoy the rest of the day, and certainly we will be back next week here on Dollars and Cents. If you have any questions or any thoughts on the program, feel free to reach out to us at the office, 407-629-6477, or go to our website, Nelson Financial Planning. This has been Dollars and Cents with Joel Garris and Kristin Kalley of Nelson Financial Planning.